Well, thanks so much for tuning into Talking Point, and it's a very important conversation today, considering that the markets are in a bit of a tizzy, and also considering that the guest who's on our show today, their mutual fund schemes across segments are turning out to be amongst the best performers over the last 12 months. The question to Sandeep Tandon is, what does he believe the next 12 months would be? And Sandeep, I would start off by, firstly, of course, congratulating you on a splendid performance for the last 12, 24 months, but also requesting you to try and wear a hat of a long short fund manager as opposed to a long only fund manager. What's your sense, Sandeep? There is a bit of a how do I say, not gloom and doom, but a bit of a skeptical view around in the markets, believing that there is still some time to go before we find a semblance of some bottom. What's your sense of how are we poised for the next 6 to 12 months?
So, like we have been talking about that 2022 will be more volatile than 2020 and 2021. And this is the time where you have to capitalize on the shorter term moves, okay? Whether you want to call it tactical calls or a strategic call, whatever name you want to give. But ultimately, you have to play the cycles, okay? If cycles are here for a short-term perspective, then you cannot talk about long-term all the time. Okay, so that's the reason we try to dissect and understand what type of environment we are operating. Once you get a better hold on the environment, then you can optimize your strategy, rather than using one single strategy all the time and then crib about it, the market is not working in your favor. Okay, I think market is very unique. Okay, it gives a fair opportunity to everybody, and it's up to us how well we can capitalize.
Okay, so Sandeep, can I ask you if right now is your mindset thinking about 6 months and 12 months, or is that also too long a time frame in the current circumstances?
No. See, the way we construct our portfolio, we try to look at something which has structured bull run. Okay, and those are long-term calls. Like commodities, I have been talking about from 2020. These are structured bull run. Okay, people have never believed it, and because people don't want to believe it, because historically they have not made money in the commodities. There's a legacy issues behind that, and it is not easy because most of the people look at the company specific approach, bottoms up approach, and where metals are very macro approach. Okay, so if you ask me, as a house, we are very constructive on, despite today commodities are corrected and you are seeing the 3 to 5% knock in across all the commodity stocks, okay, or various even asset classes we look at. So I think those are the long-term calls. Okay, then you have a medium-term calls also. Okay, which could be, like I said, that technology stocks have peaked out in September 2020. We said that this is a time to look for value stocks. Growth stocks have seen euphoria, but value is not. So the entire portfolio we have shifted towards value by we define value in a different manner, but even I will go with a traditional approach. Okay, that also makes sense. To have a value centric, we believe financial has potential to outperform technology, which it performed in last one quarter. Okay, so those are medium term calls, and then you also have a short term call. So we run our portfolio on all three approaches rather than saying that everything is long term or everything is short term. Okay, so we have to combine it, and then it gives you better result.
Okay, just before I ask you about the short term, just quick question, because in your being relevant notes that I've read, you combine the global macro and the developments with the local aspects as well. What kind of dangers or what kind of challenges that the global macro pose in that the rate hikes that we haven't seen thus far, the money withdrawal, and the ongoing conflict and the resultant impact on supply chains and commodity prices? What kind of dangers does that pose?
See, first of all, let's be very clear. We have been showcasing right from 2019 that 2020 commodity prices rally and inflation will come back. And we have written in the same book that inflation will come with a bang from 2021. Okay, and it has performed so far very well. And if I have to go by same larger term thesis, which we have was instrumental in predicting, or predictive analytics, which we talk about as a concept, clearly endorses that inflation has potential to move up till 2027-28. We believe that developed markets, so I'm making a very clear distinction, that developed market inflation can remain inflation and interest rate will remain elevated for a longer period of time than what people are visualizing. Okay, but I said since markets are very dynamic and you have a central bank playing an equally important role, I think we will see multiple rounds of tightening and multiple rounds of easing by the time we reach 2027-28.
Okay.
Okay, like beginning 2008-9, we saw first time of easing, and we thought it's a one-time phenomena, but we have seen 5 or 6 rounds of easing which is happening, and between two rounds of bit of tightening also. So I think this is the phase which we are in. We call it 2020 till 2030 will be the biggest wealth destruction phase globally. But it's up to us how well we can capitalize that cycle, because everything will go through a cycle and every move will not be linear. You will get opportunity to play that cycle. If you play these cycles well, then you will able to generate alpha even in this uncertain environment, and you can sometimes generate extraordinary alpha if you're able to identify these inflection point. And this is something which we try to do at our.
So what is the current picture? What is the next 3 months, 6 months, whatever the time frame that you might be comfortable sharing? What is the next 3 to 6 months time frame looking like?
So
Global versus, I mean, just opposing global and local is what I'm trying to say.
I just want to say that if I have to look at the very near term perspective, then I'm more bullish on the market than the consensus on the street. A very simple reason for it: the fear element is too high. Okay, when you talk about inflation fear or interest rate fear or the war related fear or the commodities prices, geopolitical, and that list is quite big. Okay, as a fear which is holding people not to participate in the market. Okay, despite knowing that this could be opportunity. Okay, so I think when we talk about 2020 will be 22 will volatile. So we will play as long fear remain elevated, we will be participating in the market. When the complacency get built, we like to prune our exposure. And currently, if I have to say, fear is extraordinary. Okay, and very interesting. Like I talked about in September 2020-21, saying that we are seeing euphoria globally. And if you dissect euphoria, then you see growth euphoria, not value. And we similarly spotted that risk appetite, global risk appetite was declining, liquidity was declining. But very interesting, what has changed in last 1 month, the risk appetite has started improving, okay, which is led by China. Okay, and China was the first market which has corrected substantially right from February 2021. It was under massive correction. So China risk appetite, despite all negative news, is there in the market, but we are ultimately a data-driven house. Okay, so our macro data showcase the risk appetite is rising in China. Money flow towards Chinese equity is also inching up. Okay, so they are, and Chinese has also pumped slightly more liquidity as compared to what they were relatively sitting on sidelines. Okay, so I think a lot of things, and China is one a large component in the global economy. Okay, so though we remain very bearish from China from a longer term perspective, but from a very near term and medium term perspective, I think it is improving. So is the case with India. India risk appetite is also rising. Even US risk appetite is rising. So it's the early signs of a recovery. That's the reason I believe, okay, that you might see a bigger move first before market can correct significantly. Okay, so from a very medium term perspective, my bias is more on the long side. And when complacency get built, and maybe I'm not ruling out market touching close to 20 or 20 whatever all time high, or maybe crossing that number. Okay, that level of pessimism is there, but those are like scenarios which we talk about. We don't work with that mindset. Yeah, it has to reach. When I say it has potential to reach, means the multiple data points which we look at, if I have to combine the big picture and say this is what this looks like, that this will emerge first and then market can correct. Okay, so if you can play your sectors right, okay, that is the way you will generate good amount of alpha in the current environment also. And if you can, it's not about the stock selection, it's about the sector rotation. If the sector rotation calls, which we generally take on the macro basis, plays out well. If you look at some of the heavyweights in the index is actually inching up. They are making 52 weeks high, and there are many names which are inching down. So it's a combination if you can, and those are the stock which is inching up are most hated territories. Most of the PSU, nobody wants to talk about, nobody wants to even discuss those names. Okay, those are the area which are beaten down. There is a value neglected, or I say in my behavior analysis, I call they are trading in the most hated zone. Okay, so those are under research, under owned stocks. Those are the theses which will play out. Okay. And but there's a mindset game. People don't want to participate.
Sure. Last couple of questions, Sandeep. So you're saying that am I reading this correctly? You believe that, a few 100 points here and there is fine, but you believe that from now until whatever the near term might be, there is a probability that the markets might actually a higher risk reward from a tactically long trade in select sectors as opposed to the risk on the short side.
Correct. Absolutely right. That's our thesis which we are working right on our portfolio.
Got it. And may I ask you before we wrap up? So you identified metals very early. You identified that swap trade between IT and say maybe financials and maybe PSU sometime back. I'm trying to understand if you are playing that tactically long trade right now, what are the themes that you believe could do well?
Yeah, I think financial is the theme which will play out very well. And within financial, PSU bank themes will outperform the private sector. So that's the important call which you like. So we would like to take PSU banks as a big picture call for us. Then followed by we like energy space doing still very well. Okay, there's a global shortage on coal side. There's a global shortage of energy. I think energy, power, whatever name you want to look at, maybe different indices have different component. But if I have to say energy as a theme or power as a theme should do very well. Similarly, if I want to talk about then media as a theme, it should also is again most hated, most neglected territory. They have not performed for years. If I have to add something more in the infra name, select infra name is another theme should play out quite well. Okay, where a lot of people don't want to even touch that. Okay, but there are certain companies with balance sheets significantly, or the management change has happened, or something is changing. Okay, so early signs in these sectors where one can look for opportunity. Telecom continues to remain bullish and isolated from what. So basically, whole idea is that if you can avoid the consumption driven names, which is more impacted by the inflation and interest rate environment, those are the names which we don't own it. Okay, we really don't know how to play auto in this background. Okay, so where rural economy, which we expect should do far better than the urban economy going forward, but that is a very tricky situation. So it's a combination which we are trying to work on it and try to see if we can get some opportunity.
Great. Sandeep, we'll leave you at that. I understand it's a busy morning. Otherwise, we would have extended this conversation. But thank you so much for taking the time out and speaking to us today.
Thanks a lot.
Viewers, thanks for tuning in.